Good morning, everyone. Hope you're having a great start to your weekend. It's Sean with Paycheck to Portfolio. Today, I'm going to talk about and really start a new series called The Bottom Line. And this is going to be a monthly review of the prior month just to see how dividends rolled in, what my aggregated dividends looked like, kind of a top 10 performance. We'll look at a dashboard I'm creating, some options and final thoughts. So, this will be, again, a monthly series that you'll be able to watch every month and track my progress. Before we jump right in, I'm going to take a look at our portfolio, just like we always do, to see how we're doing. Currently, the net account value is sitting at $142,157 there. My total unrealized gain is sitting at almost $35,000. The market's been pretty volatile lately. As everyone probably knows, we're expecting or hoping for some rate cuts here in mid-September. I think the announcement actually is expected on September 17th, if I remember correctly there. So the last week, the market's been up, the market's been down. It's kind of been all over the place. You'll see a quote I mentioned by Warren Buffett here in a little bit. But Friday, we were down $490 basically. But we had some dividends that rolled in. And again, I'm going to touch on that in a whole month review. Let's see performance. So if you scroll down here, you can see my year-to-date performance, currently basically at 33% cumulative performance. The S&P is at 8.5%, the Nasdaq's at 10, the Dow's at 5.6, and the Russell's at 6.5. On the one-year chart, I'm sitting at 56.5%. The S&P is basically at 20. The Nasdaq's at 30, the Dow's at 12.5, and the Russell's at 14% basically. On the 3-year chart, currently I'm sitting at 91%. The S&P's close to 60, the Nasdaq's 79, and the Dow's 41 basically, and the Russell's getting close to 26% return. This is time-weighted return and cumulative performance. This does not include any cash that I've added or cash that I have withdrawn. That's on the historical values tab, which is here. So if we look at this briefly, you can see over year to date, I started out in January at $108,000, and the ending value is getting close to $143,000 with a change of about $35,000. If you're new to my channel, all of my W-2 income rolls into a brokerage account. I don't live out of a traditional checking account. I buy long-term growth, closed-end funds, and high-yield funds. And what happens is that produces dividends, which over time will, in a good way, erode my expenses and allow me to live free from a 9-to-5 job. We often refer to that in the community, and this has been around for a while. It's called FIRE, which stands for Financially Independent Retire Early. So I'm front-loading my investments instead of investing the leftovers, which creates a velocity of cash flow and compounding. And over time, that will set me free from a 9-to-5 job. So jumping right into the Excel file, if you look at dividends by date, basically I have multiple tabs down here. You'll see the transaction date here, starting obviously at the beginning of the month. You'll see the tickers here or the symbols. And then you'll see the dividends that I received, any interest that I had to pay out as a red expense. And I'm just scrolling through just so you can high level see it. And then basically I have a net cash flow or a net income down here that's summed up, but I have it mapped out in some charts. So very high level for the month of October, we brought in obviously $4,400 of dividends. I paid out 950, call it 951 of margin interest. I have negotiated my interest rate down with E-Trade to 8.4%. You can call up your brokerage very often and ask them to lower your margin interest rate. I've done it a couple times. I'm going to do it again here before too long. And if we get a rate cut in September, obviously that will reduce the interest rates as well. What I did is I aggregated the dividends by payer because some of these dividends pay weekly, some of them pay monthly, some of them pay quarterly. So I've aggregated those by symbol here. And again, I have this charted out. I'm just showing you how the logic is basically built behind the chart. So you can see the total outside of interest was $4,439 for the month. And then again, when you calculate back in interest, the net is $3,488. looking at a dashboard I'm working on creating and a template that my community would be able to use, and just a standard template to review every month in this series. I'm going to start breaking this out, and feel free to give me feedback in the comments, and I can make adjustments. But looking at total payers, and I'll click off of this so it's a little bit easier. You can see MSTY paid out basically $747. I think they paid twice, basically in August, just by the number of days and the way that hit. So again, we had a $748 dividend payment that came in from MSTY. You can see I own AMSI, which is the covered call ETF on Amazon. That paid out $427. If you look at CLM, these are Cornerstone closed-end funds I talk a lot about, which I drip these at the NAV. Paid out $370. CRF $317. QQQY paid out $311. Going to move through these a little bit quick just so we can look at some of the other ones. PLTY basically $300. RDTE $292. WiMAX $285, we'll call it. NVIDIA $228. XDTE 220 or 212 there. IWMY 165. QDTE 129. QQQI 113. MST 103. ULTI 102. SMCY 96, we'll call it. GOF 87. HUI 65. TSYY 54. And XBTY was $30 there. And I know that was a little rigid going through each one of them, but I really do want you to see which ones are paying the most and how that's aggregated across all of my investments. If you look at my future payments for the next 12 months, this can be hard to project because obviously we don't know what each fund's going to pay. But you can see September I'm projected at 4.4 thousand. Or 4,400. In October, we're looking at 4,600. You could see the rest of the year there. That's because I invest into three buckets: long-term growth, closed-end funds, and high yield funds. What I'm trying to achieve in the system that I've created is I want growth, long-term growth. I want compounding by dripping at the NAV with Cornerstone. And I want the high yield cash flow, and to basically triple lever all those movements of money to essentially compound my account quicker. So again, you can see the next 12 months. If you look at my monthly expenses covered, if you look at the gross amount here, I'm basically at 53, approaching 54% coverage. I need about $8,333 to live every month. We're a family of 6, 4 kids. So obviously things can get expensive, and there's inflation and other things. So I'm projecting about $100,000 to $110,000 a year that I need to live free and clear from a 9-to-5 job. And from a gross perspective, I'm a little over halfway there. If you look at the net expense, and again, I look at my finances like a business would look at a balance sheet. Obviously, you need to calculate back in expenses and deduct those from, your net income, your bottom line, and that's how a business will look at things on a balance sheet. So if you take into account the expenses, the margin interest rates, the insurance, which we'll talk about in the form of options, put options coverage, I'm sitting at about a 40% coverage right now, and you can see the net there is $3,339 with a target of $8,333. If you look at the breakdown of the chart, just on a pie chart, 82% of my dividends I took as cash that covers margin interest and helps erode my expenses in a good way. Obviously, month over month, reducing those expenses, which will essentially set us free from a 9-to-5 job. Drip is what I'll use for compounding. I drip my long-term growth stocks and my closed-end funds. Again, Cornerstone drips at the NAV discount, which we've talked about in prior videos. GOF drips at a 5% discount to its NAV. So each one of those drips allows the account to compound faster. And then obviously I have the cash flywheel portion of that as well. So looking at options, I get a lot of questions around put options, how I manage options. So I'm trying to keep this very simple. I have another video about how I protect my portfolio from a market crash. I definitely recommend you check that out. My current put option contracts, I have put option contracts on QQQ, I believe 2 contracts currently. The expiration date is September 26th. It's a 480 contract or strike price. My rules are I go 30 days out, 10 to 20% out of the money, depending on what the VIX chart is doing. And the VIX is basically the fear index. If you Google VIX chart, it'll show you when the fear index went high over the last 20 years. The highest VIX chart increase was in the 2008 housing crisis and market, I would say, crash. The second one was 2020 with COVID. And ironically, the third one was the tariff situation we just went through in April with a 20 to 25% correction. People ask me, how would your account handle a market correction or a market crash? And I jokingly, even myself, I kind of joke inherently that, in America, we tend to have short-term memory loss because our news cycle comes at us so fast these days. And it's not obviously just our country, but, we have our devices in our hands, and the news cycle will change minute by minute, and then we tend to forget. But in April, obviously, we had a 20 to 25% correction, and that is the definition of a market correction, even though it only lasted a week and a half. In that case, at one point, my portfolio value had dropped $15,000, but my put options kicked in and covered about $10,000 of that. So I had a net $5,000 loss. I want to show something to you just very transparently, and I always try to do that. If we go to my full portfolio, I'm going to show you I was actually buying during the market correction in April. And you'll see that on, let me find NVIDIA here because it's a good example, and apologies. I just want to show you transparently, when I say my put options kicked in and I was buying when other people were selling, that's the case here. You can see I was buying NVIDIA with the China tariff situation and all the fear that went in there. You'll notice a pattern with these dates all in April, and you can see the return I got on that. So what put options allow you to do is not to panic. When the market corrects or starts to crash, these put options contracts increase in value exponentially. It's just like a homeowner's insurance policy on your house. You hope you never have to use it, but it's there if things go sideways. That's what happened in April. Again, my account value dropped 15 grand. My put options kicked in and covered 10,000 of that. And I was able to continue to buy when everybody else was a little bit scared. So SPY also, I'll buy options contracts on. Currently, I have a 926, 555 there. Going through my rules a little bit more systematically, 30 days out, 10 to 20% out of the money. Obviously, I try to buy these when the VIX is lower because the insurance is cheaper at that point. I budget around $100 to $200 of expenses a month on this. So if I can, I try to buy 2 QQQ and 2 SPY. And if they go up 50%, 75%, 100%, I'll sell one and then keep the remaining 2 contracts. So one left on QQQ and one left on SPY, and just let those run and set trailing stop losses so I can get additional income from them. With the tariff situation in April, the market moved so quick. My put options contracts were up 1,000%, 1,500%, 2,000%. So when I would sell these, I would immediately add them back with the 10 to 20% rule at that point in the market, and they just kept compounding. So, and the way I manage them is towards the end of the month, I'll roll them 5 to 7 days before the expiration. And typically what happens is there's very little value left because the portfolio typically grows, and then these lose value. And again, I look at these as insurance. Some of the lessons I learned this month is consistency is key. Even in the community that we have a Discord, a membership, really, really, really sharp people. in the Discord talking, you know, finances in the stock market can be emotional at times. I've been investing since 2008. Right when I started to invest, the housing collapse happened and the financial crisis. And so, you know, I learned right away in my journey that you just have to stay the course. You have to keep investing. You have to keep compounding your cash, because over time the market will recover and it will grow. And so, you know, it's easy to get caught up in day trading. It's easy to get caught up in how quickly can I make money versus how consistently can I create money and cash flow. And in this system, we're compounding all of our W 2 income or all of our investment income on the front end instead of investing the leftovers on the back end. Most Americans invest 5, 7%, maybe even less these days. And then they wait until they're 65 to retire because we have to. And then, you know, unfortunately, folks typically will pass away in their mid 70s, maybe later 70s. You know, my dad was I was a late child. I'm the baby of my family. My mom was 40 when I was born. My father was 50. I'm 43 currently. My dad went through the Great Depression, the tail end of it, and so, you know, he was always afraid to take some risks a little bit. He was always very cognizant of the food that we had, and so, you know, great father. I was very blessed. Miss him dearly. I'm looking forward to the reunion in heaven with my father, and I'm so thankful for the time we had. But what I would say is consistency is the key. And my dad worked so hard his whole life, retired, you know, in his mid 60s, and then passed away a week before his 71st birthday. So time is so valuable, spending that time with your loved ones. And so in the system that I've been able and fortunate and blessed to come upon and to implement is front loading the investments so that I can break free from corporate America in 5 to 10 years versus 30 to 35 years like most Americans. Okay. And I know I went off on a little bit of a story there, so apologies, but that's really what we're trying to do when we talk about a FIRE lifestyle. So consistency is key. Try not to get caught up in the get rich quick type of feel, or retire in 6 months versus 5 years or 4 years. To me, that's fast. That's very quick compounding compared to traditional methods. So consistency is the key. Diversification is always so important. Again, some of the things I'll see in the community is people tend to chase the highest yields. And so I invest, like I always say, in the three buckets: long-term growth. Those are my SPYGs, my Costco's, McDonald's, and others. Those just allow the account to grow over time and they have good, solid returns. My second bucket is closed-end funds, Cornerstone, Goff. Those drip at NAV or NAV discounts, which allow you to compound faster and they grow. And then high yield funds are my third bucket, which allow me to cash flow and to produce month over month, week over week, quarter over quarter dividend payments. And I'm always looking for ways to diversify, even amongst the companies. And so lately, what I've been doing is investing in real estate. You can check that stock and ticker out. I believe it pays a 6 or 7% dividend and it grows. And then KGC, one of my members had reached out to me. His name is Shane, I believe, off the top of my head, and always very willing to share, and gave me a gold stock. I believe they're actually a mining company. And so I added some real estate holdings to my portfolio, and based off of a member recommendation, KGC, which is a gold. So you always want to look at your sectors that you're investing in, your diversification, and most importantly, the three buckets. That's what I'm looking at. And that's my strategy always, and certainly moving forward. And some of the additions I made in August and early September here. Looking at final thoughts, I want to talk about a few things. So Warren Buffett often quoted The Intelligent Investor by Benjamin Graham. One of the most powerful lessons in the book is the story of Mr. Market. Graham describes Mr. Market as your business partner who shows up every day offering to buy your shares or to sell you his. The catch? His mood swings wildly. Some days he's euphoric and offers crazy high prices. Other days he's depressed and offers rock bottom bargains. The key lesson is this: you don't have to follow Mr. Market's emotions. You're free to take advantage of him when it suits you, or ignore him when it doesn't. The value of your investment doesn't change just because Mr. Market is acting irrational. And that's what I always try to remind myself is let the market come to me, stay the course with the plan, invest into the three buckets. And if you know something's cheap, go ahead and make an investment. And if you know something's expensive, maybe dollar cost average into it, or potentially, obviously, wait for a pullback. And so, my prediction, this is only my prediction right now. I think we get a rate cut coming up here. I think the market will continue to be bullish. Again, these are all my opinions. So I've been dollar cost averaging lately, and I have been diversifying, as we talked about. And I'll continue to stay the course with the plan. But this is a good reminder for me. If you're interested in additional resources, at the bottom of every video I post in the pinned comments, I have all of my links here. You can grab the free starter kit if you want to look at my system holistically and you want to see just a simple calculator and how your finances could be impacted. You can grab that. You can book basic one-on-one strategy calls with me. That's available as well. We have a private Discord and membership. We have tools there, a community there. Again, very, very sharp people, super impressed and super happy with just the feedback and the teamwork we have going on and just the growth within that group and helping each other out on this journey. And then I have white gloves set up in coaching if you need some intensive training and shoulder to shoulder strategy and help. That's available to you as well. So I hope you like this monthly review and this longer form video. Please like and subscribe and share if you found this useful. And I hope you have a great rest of your weekend and week. And we'll talk to everybody soon.